This is a demonstration of problem 9A 41B, journalizing partial year depreciation and asset disposals and exchanges. During 2018, Laura Company completed the following transactions, and the problem gives us transactions that we are going to need to record in the Journal of Laura Company. The first transaction is on January 1st, and the problem states that we traded in old office equipment with a book value of $55,000, cost of $129,000, and accumulated depreciation of $74,000 for new equipment. Laura also paid $55,000 in cash, and the fair value of the new equipment is $116,000, and we're to assume that this exchange had commercial substance. So before we can record this transaction, we need to determine whether or not Laura Company has experienced a gain or a loss on the exchange of this equipment. So we start out with the market value of the assets we received or the new equipment, which the problem tells us is $116,000. Then we're going to compare that or subtract from that the value of what we gave up. The first thing that we gave up, of course, was the old equipment that we traded in. So the book value of the old equipment, the problem stated, was $55,000, which is the difference between the cost and the accumulated depreciation. But we also had to pay another $55,000 in cash. So altogether, we gave up an asset and paid cash that totaled $110,000. But since we got an asset that was worth $116,000, we actually realized a gain on this exchange of $6,000. So now we can record the transaction. The first thing we need to do is to record the new equipment at its market value of $116,000. Then we need to remove the old equipment from our books. The first thing we're going to do is we're going to debit the accumulated depreciation of $74,000. So that will zero out that account. And then we're going to credit the cost of the old equipment to get it also off the books of $129,000. So now the old equipment will be gone. We also need to credit cash for $55,000 because we had to pay them that. And then we're going to record the gain. So our gain on our disposal is $6,000. Now when you're making these types of kind of difficult entries, you want to check and make sure that your debits, $190,000, equal your credits, $190,000. And that's just a good check to make sure that your calculation of your gain or loss was done correctly. Next, on April 1st, it says that we sold equipment that cost $12,000, had accumulated depreciation of $1,000 through December 31st of the preceding year, and Laura received $7,100 cash from the sale of the equipment. Depreciation is computed on a straight line basis, and the equipment has a 5-year useful life and a residual value of 0. So we know we sold this equipment on April 1st. So that means that we need to first record the partial year depreciation on the equipment before we can determine whether we had a gain or a loss on the sale. So we're going to calculate that depreciation starting off with the cost of $12,000. There's no residual value, so there's nothing to subtract there. The problem states it had a 5-year useful life, and we had it for 3 months, January, February, and March, before we sold it. So we can see, based on our calculation, that we need to record $600 of depreciation expense for this equipment prior to determining the gain or loss. So on April 1st, we're going to debit depreciation expense for $600, and we're going to credit accumulated depreciation equipment for $600. Now we're going to calculate the whether we had a gain or a loss on the sale of the equipment. Now this, we didn't make an exchange, but we were actually paid $7,100. So we're going to start out with that amount. $7,100 is what we received. Then we're going to determine we're going to record our cost, which was $12,000, and then we need to record the accumulated depreciation because we're trying to get to our book value. We had $1,000 for the previous time, and now we recorded $600. So we have a total of $1,600 in accumulated depreciation now for this piece of equipment that we sold. So now we can see that we actually had a book value of the old equipment of $10,400. We only received $7,100 cash. So that means we actually experienced a loss on the sale of this equipment of $3,300. So now we're ready to record this transaction. We debit cash for the $7,100 we received. We're going to debit our accumulated depreciation for $1,600 because remember we're removing this equipment from our books. We had a loss on the disposal which we calculated of $3,300, so that would be a debit. And then we're going to credit equipment for the original cost that we recorded it at, $12,000. So that would be the entry, but let's check and make sure that those debits equal $12,000, and they do. So now we have completed recording the sale of the equipment. The last entry says that we're going to record depreciation expense on the office equipment. So this is going to be that new piece of office equipment that we bought on January 1st, and it says we're going to depreciate it using the double declining balance method over 4 years with a $7,000 residual value. Well, remember when we record depreciation using double declining balance, we actually do not subtract the residual value. We depreciate the equipment but at cost minus accumulated depreciation, but not below the residual value. So we're going to calculate the first year of depreciation starting with the cost of $116,000. We had no accumulated depreciation because this is a new piece of equipment, and our double declining balance rate is going to be 0.5. Why is that? Well, it's 2 times the straight line rate. The straight line rate would be 1 divided by 4, which is 0.25. 2 times that is 0.50. So our depreciation on this equipment for the first year is going to be $58,000, which is $116,000 times 0.5. So we're going to make that entry by debiting depreciation expense office equipment for $58,000 and crediting accumulated depreciation office equipment for $58,000. And that is the last entry that we had to record and the conclusion of the demonstration for problem 9A 41B.